Hi everyone. Hope all are doing well. We are back with another video to discuss about how valuation looks for different sectors and for different industries, right? And obviously there are a lot of industries which we are talking about today, which where startups and companies are operating. However, we'll try and see a couple of them just to understand how valuation looks for these different set of sectors. First and foremost, let's understand that each sector on its own speaks a very different language. So each sector has to be valued on certain different terms. So, for example, let's understand about technology companies. You see SaaS and app businesses, they prioritize customer acquisition over the near-term profit. Why is that so? Because first, it's important to get customers on the platform, and then obviously revenue starts coming in by acquiring these customers. And hence, in such cases, the traditional DCF model actually struggles a lot. So bankers rely heavy on certain other metrics. And what are those metrics? Such as the enterprise value coming from ARR, right? Which is nothing but your annual recurring revenue. So once you understand what is the annual recurring revenue coming over here, you apply a multiple. It could be a revenue multiple, it could be an EBITDA multiple to that particular number, and try and come on to a valuation number for that particular startup. Obviously, there's another rule called as the rule of 40. But then again, that comes at a stage when the company start generating revenue, which is nothing but your revenue growth rate plus the EBITDA margin that should always exceed 40%. Another one is your LTV by CAC. Now, LTV stands for the customer lifetime value, right? So how much you are able to generate revenue from a customer over the life of that customer. That means till the time the customer remains on the platform versus the customer acquisition cost. So the cost in acquiring that particular customer, that becomes another important metrics to understand for such technology startups. Now, let's talk about healthcare and biotech. Now, how do we evaluate more from healthcare and biotech point of view? Now, any pre-revenue biotech firm, they are valued after using a formula for risk-adjusted NPV. We all understand NPV stands for net present value, right? However, why are we trying to adjust the risk? The simple reason is because, biotech firms work on finding out, how successful the trials for new drugs, which they are, working on will be. And hence, any expected future drug cash flows which are multiplied by the statistical probability of passing each clinical trial phase and receiving the regulatory approval. That becomes the way of understanding how the healthcare and the biotech firms are used for valuation. Now comes another sector, which is your financial services. Now, for banks and insurers, debt is actually the raw material, right? So it is not a liability which is to be minimized. So enterprise value is irrelevant in this case. Now, where we talk about what is the best methodology, there are two. One is price to the tangible work value. Why? Because it maps capital adequacy, which the banks or the insurers have to maintain against the returns which they are able to give. Dividend discount model helps you match the regulatory capital requirements against the payout ratios. So these two parameters become important in case of companies which are into financial services. Now let's talk about those companies which are having sort of a lot of physical assets. For example, let's take one of the sectors, which is real estate. Now, real estate, obviously, we understand both. There are two types, which are commercial and residential. Let's talk more from a commercial point of view. Now, commercial real estate is nothing but office parks, which you have seen, logistics hubs, then retail malls. These are all valued using the capitalization rate. Now, what do we understand by capitalization rate? Capitalization rate is nothing but the net operating income which these commercial real estates are able to generate, which is divided by the property value, because that actually creates the valuation for the commercial real estate we're talking about. Now, REITs, which are nothing but the real estate investment trusts, they are commonly valued using price by FFO, which is nothing but your funds from operations, which adds back all the non-cash expenses such as depreciation to the net income. So commercial real estate are valued on capitalization rate. Now let's understand manufacturing. Now in case of manufacturing, which are actually asset heavy businesses, right? These industries are evaluated using the capital intensity. Now, In such cases, EV by EBITDA is a more, or I would say rather, an EBITDA multiple becomes a more, heavily utilized multiple in terms of understanding the valuation for the manufacturing firm. Why? Because by the time you come on to EBITDA, it normalizes all different types of non-cash expenses, which are depreciation policies across the peers, right? And obviously, we all understand there are two types of capexes which are happening, in manufacturing firms. One is your maintenance capex, and second is your growth capex. Now, what is the difference between the two? See, maintenance capex will only help in maintaining your assets. It will not result in increasing the valuation. It will only help in maintaining the current cash flows which are getting generated from the business. However, when you are going for a growth capex, it typically means that you are planning to generate incremental value in the company. So incremental cash flows will start coming in, right? It expands the capacity of the manufacturing firm, and hence in such cases, EV by EBITDA becomes a more prominent valuation methodology for manufacturing firms.